All right, U.S. stocks are up 50% from their March low, but has the anticipated recovery been priced in? We are asking Rich Weiss, Chief Investment Officer at City National Bank. Rich helps manage $13 billion of City National's $50 billion in assets, and their core equity strategy has outperformed the S&P 500 9 of the past 10 years. Rich, one thing we've been reporting on this morning, this notion that even after the rally we've seen, equities remain undervalued. Is that logic that you buy into?
Oh, yeah. The equity market's clearly anticipating, 6, 9, 12 months out. So it's very logical that they appear undervalued on today's earnings, maybe even based on forecasted earnings.
Now, is that an analysis that we can apply to the broad market, or do you feel that certain sectors remain more undervalued than others? And if that's the case, which ones?
Well, we're neutral on industrial sectors, but we're taking a heavier overweight in smaller and mid-cap stocks, a more aggressive, beta-oriented position to prepare for a rally to come later this year, next year.
How much further do you think the stock market could go?
Oh, well, the long-term average is 10% a year. We think it can do at least that next year.
Okay, now this is on the basis of the outlook for corporate profits, because there are many caveats that get thrown into the analysis as to whether A, corporate profits are really rising that quickly, because some people say you have to go back to where we were before the crisis, and the other being that there are still some one-time factors, perhaps tax loss effects that are inflating the kinds of corporate profits that we'll be getting for the next year or two.
Yeah, it's a combination of all those. We have technical factors, we have economic factors, we have valuation factors. Our disciplines at City National try to incorporate all three. Based on an assessment of all three of those, we see the equity market is fairly attractive right now.
Rich, what if you're wrong? I mean, how are you hedged?
Well, we have equities aren't the only thing we invest in for our clients, so we have fixed income allocations as well. We have commodities, hedge funds, so it's a broad diversification. Stocks represent the growth portion of the portfolio.
One thing that we've been noticing and talking about this morning is we have this worldwide equity rally. We also have bonds seeing some support, Treasury bonds seeing some support. So do you think this just shows to what extent really there's a lack of conviction? Okay, stocks are going higher, but there seems like a lot of people are hedging their bets.
Yeah, no question. The markets seem conflicted, with equities going one way, bonds going the other. We see it again. The economy is not out of the woods yet. It'll take some time. Obviously, monetary policy is holding Treasury yields down to some extent, but the rest of the credit markets have rallied fairly significantly. So all the markets are still looking for a positive trajectory over the next 9 months or so.
Rich, though, what has changed since the summer? Because back then, when equities were strengthening, bonds would be weakening, the dollar would be going down, and gold would also be going down. Now we have gold hitting $1,000, right? We have, as Deirdre mentioned, Treasury yields declining, prices are going up, yet equities are moving higher. Has there been a disconnect? Has a relationship ruptured? And if that's the case, how do we need to think about this going forward?
Yeah, I'm not so sure the markets have ruptured here. I see gold in particular as an inflation hedge. Also, gold carries a lot of investor sentiment with it, right? It's a safe haven, so people run to it when they fear inflation and the U.S. dollar.
But if they're fearing inflation, how could the 10-year yield be dropping at the same time and stocks going up? Because that's a risky asset that people aren't running away from right now.
Well, clearly, again, monetary policy, I think it's not the best thing to look at Treasury yields right now. Look at the credit markets, right? Look at corporate bonds. Corporate bond yields have come way down. So that's really where the action is, and that's where you can really get a sense of where the markets are pointed to economically, not the Treasury market.
You're weighted 60-40 equities to fixed income. At what point do you think you'll be prepared to change that weighting with more emphasis on equities?
Most likely later this year. Again, we have changed the makeup or the constituency of our equity portfolios to take on more risk, but probably later this year. Check in 4 or 6 months from now.
We will.
All right, Rich, thank you very much. Rich Weiss, Chief Investment Officer at City National here in New York, normally in Beverly Hills. We're very glad to have you.